The next efficiency ratio we'll look at is the accounts receivable turnover. This ratio is very similar in its structure to the inventory turnover ratio, except now we interpose accounts receivable in place of inventory. The second factor we need to mention is that this ratio is used for internal purposes for those within an organization instead of externally from those outside. This is because it is almost impossible to garner the necessary inputs unless you have access to internal reporting. That is, you need to know the level of credit sales made in the period. Therefore, unless you know the business credit policy and the proportion of credit sales to cash sales, then you will be unable to calculate this ratio. However, if you do have all the required information, what does this ratio tell you? It tells you how times over you turned your accounts receivable balance into cash, how many times you built up an account receivable balance, collected the cash, and repeated this. The benefit from knowing the result of this ratio is that it can assist you with cash flow planning and assess the level of success within the collection department. While knowing how many times an account receivable balance is turned over isn't that useful in isolation. The result can also be used as a good benchmark for measurement over time. Further, as it moves scale from the business, the benchmark can be used within an organization that is changing in size. So to calculate this ratio, you have to apply the next formula. We have to divide the credit sales by all of the account receivable at start of period plus accounts receivable at end of period divided by 2. Let's take an example to understand it. Let's suppose that we have a credit sales of $1,115,000 of account receivable at start of period and $400,000 of accounts receivable at the end of the period. So the account receivable turnover will be 3.63. What the result means? So a figure of 3.63 means that the business turned their complete accounts receivable balance into cash 3.63 times over throughout the period. What it means if the account receivable turnover changes? Now, there are three main causes to a change in accounts receivable turnover, with two being genuinely under the control of management. The first, under internal control, is that new processes, systems, and or management have changed the success in which they collect debts. If the account receivable turnover increases, then the account receivable and collections team have become better at achieving a core function. This is generally a good thing. When the account receivable turnover falls, the opposite is true. The collections team is performing worse, or if there is no dedicated collections team, then the accounts department is dedicating less time and effort on managing a key aspect of cash flow control. The second reason under internal control is that there has been a deliberate change in the credit and collection policy of the business. A business may have changed its payment term for strategic or cash flow reasons, and customers and the collections team may have adjusted to the new payment window. For example, changing terms from 13 days to 60 days would both increase the balance of account receivable within the balance sheet as well as lower the actual rate of collection turnover. A change of credit and collections policy is very common and may result in increased sales or improved cash flow. The final reason not under the control of management is that the general economy or particular industry may be trending towards a downturn. A general slump in business conditions may lead to everyone's cash flow coming under pressure. Often the simplest method to improve one's own cash flow is to delay or ration payments of their invoices until a later time. Delayed payment of invoices is a unique barometer of the general health of an economy or industry And the more widespread this action is, the greater the flow-on effect is, as a business may delay payment of its own invoices as it is waiting for a payment from someone else. Finally, with the drawbacks of the account receivable turnover ratio, there is one very large drawback of the account receivable turnover ratio, and it's similar to many other ratio drawbacks and comes from focusing on financial information too heavily. This drawback has been referred to earlier, and is it the fact that a company's credit policy may in fact be part of its strategy, and thus the ratio may not be a reflection of collection success at all. If a business can offer favorable credit terms by perhaps offering a longer payment window, then it may in fact increase its level of sales. So while the account receivable turnover may be falling due on an increased payment window, this may be a boon in the sales revenue account. And after all, the new customers may be big spenders, loyal customers, and may always pay on time, just a later date. In the flip side, if a business is impressed with its account receivable turnover and the management comes down hard on the collections team to hurry up and collect, and they do this, then possible loyal, long-term customers may be discouraged from repeat business by the aggressive collections team they must now deal with when using this business. It's not good business practice and maybe throwing the baby out with the bathwater to have a super friendly sales team and then a super aggressive collections team. Credit policy as a key part of any sales and client service strategy, and account receivable turnover simply does not take this into consideration. Changes in credit policy will immediately change the account receivable turnover, and unless this policy change is taken into account, then decisions based on this ratio alone may become warped.